After recent allowance cuts and rate hikes, capital gains tax can significantly impact your investment gains. CGT can skim 18% to 24% of gains above your allowance, with property gains falling within the same range. With the annual exempt amount now just £3,000, more everyday investors are in scope than ever before. In the UK, capital gains tax, or CGT, is charged when you sell an asset for more than it originally cost. This applies to various assets, including shares, crypto, second homes, funds, and certain valuable possessions. While your main home usually escapes CGT via private residence relief, your investments and second properties do not. CGT is distinct from income tax. It operates under its own specific regime. Rates are now 18% for basic rate and 24% for higher additional rate taxpayers for disposals on or after the 30th of October 2024. These rates apply to most assets and residential property, which already fell within the 18% to 24% range. Many believe they only pay when cash hits their bank, but the tax point is usually disposal or completion, not when funds are moved. Property transactions, in particular, have strict timing rules for reporting and payment. Forgetting to account for losses means you're burning money. You can offset allowable losses against gains. However, you must report these losses properly and on time, or you will lose the benefit. Effective record keeping is crucial for tax purposes. Without clear evidence of costs, fees, and improvements, you risk overpaying. HMRC's compliance push is real. Missing reports, especially on property, can lead to penalties. Unlike the US, the UK does not differentiate between short versus long-term CGT. Instead, we have one CGT regime with bands tied to your income tax position. Gains within your basic rate band can be taxed at 18%, while anything above that is 24% for disposals on or after the 30th of October 2024. The annual exempt amount, or AEA, is now £3,000 for individuals and £1,500 for most trusts. Any gains above this amount are taxable, and it's a use it or lose it allowance each tax year. For UK residential property, gains must be reported and paid within 60 days of completion via the UK Property CGT return. This is separate from your self-assessment, and missing this deadline can incur penalties. For shares and crypto, share matching rules, including same-day, 30-day bed and breakfast, and Section 104 pool, can alter your computed gains. For example, if you buy shares for £10,000 and later sell them for £16,000, that's a £6,000 gain. After using your £3,000 AEA, the remaining £3,000 is taxed at 18% if you're a basic rate taxpayer, or 24% otherwise. If you repurchase the same shares within 30 days, matching rules may attach part of the sale to that repurchase, potentially altering your gain. Now, let's explore some legitimate strategies that can truly move the needle, but remember, always seek advice for your specific situation. Firstly, make sure to utilize your full £3,000 annual allowance every single year. Consider BED and ISA selling assets to crystallize gains, then immediately rebuying them inside your ISA. This migrates assets into a CGT-free wrapper, and crucially, the ISA purchase doesn't trigger the 30-day anti-avoidance rule for the non-ISA sale. Shelter growth in wrappers like ISAs and pensions, as they shield future gains entirely. High growth or frequently traded assets are ideally placed here first, as ISA gains are not reported to HMRC. Harvest losses properly. Banking a real, allowable loss can offset current or future gains, subject to claim rules. Just ensure you don't wash it away by buying back the same thing within 30 days in a taxable account. For property specifics, factor in acquisition and sale costs, plus capital improvements, to raise your base cost. If it's UK residential property, DRIs that 60-day deadline before you even list it for sale. Selling a business. Business asset disposal relief, or BAD, can reduce the rate to 10% on qualifying gains up to a £1 million lifetime limit. This relief is huge when it applies, but the conditions are strict, so get advice early. There's been a steep reduction in the allowance, from £12,300 down to £3,000, and main rate increases to 18% and 24%. HMRC is actively nudging non-compliant taxpayers, so don't give them a reason to look your way. Capital gains tax in the UK isn't a minor detail, it's a significant financial lever. Know your rates of 18% and 24%, guard your £3,000 allowance, and plan your disposals carefully. Utilize wrappers and reliefs where they genuinely fit your financial situation. Good records and calm, proactive planning will always outperform last-minute panic. Got questions? Drop them in the comments below, and I'll tackle the thorny ones. Then, queue up my follow-on video, Tax-Saving Strategies for UK Investors, for the full playbook. Finally, remember this is educational content only and not financial, tax, or legal advice. Tax rules change, and your situation is unique. So always speak to a qualified UK tax advisor before making any financial decisions.